All right, Shalom. Welcome to another Expert Inside interview. My name is John Golden from Sales Pop, online sales magazine, and Pipeliner CRM, joining you as usual from a sunny San Diego. And today, I'm delighted to be joined by Nick Spezio, who is over on the East Coast, upstate New York, Rochester. How you doing, Nick?
Doing well. It's sunny in Rochester today, but it hasn't been the last couple of days, so not as nice as San Diego.
Yeah, I think the one or two times I visited Rochester, I think I woke up with the snow about halfway up the door. Yeah,
It was probably May or June too.
yeah,
That's
exactly. Yeah.
how it is in Rochester.
Yeah. So you joined EXBO Group in 2021. You lead the transaction services practice. You support buy-side private equity and venture capital clients. Additionally, you support sellers as they prepare for financial due diligence. And you've worked across SaaS, fintech, edtech, data analysis, analytics, professional services, and intellectual property. And that's what I thought we'd talk about today is preparing for a sale. So on the sell side, because I feel like there's a lot of people who have started businesses, a lot of entrepreneurs. I think we're entering the golden age of entrepreneurialism, and obviously a lot of people set it up with the idea, I'm going to sell this business, I'm going to get acquired eventually. But even when you're starting or setting up a business, are there things you should be thinking about, Nick, if your plan is sometime in the future to sell the business? Are there things that you should be thinking about from the get-go?
Absolutely. I mean, definitely, and I think that's an interesting point too. Is I don't think, at least a lot of the businesses that we do our financial and tax and operation due diligence on, I don't think that they implicitly had the mindset of one day I'm going to sell this business. Maybe some, but I don't think a large cohort of those businesses ever were thinking that way. But I think you're exactly right. Nowadays, if you're starting a business, a lot of the times you're like, well, at what point do I exit this business or take on some growth capital or find the right partner to help me take it to the next level, continue to develop and improve my product, get more customers, market this the right way. And you're thinking about it exactly right. Not only thinking that way will help you maximize your initial check that's written to you when you do decide to sell the business or do whatever you want with that initial investment. But it's important to get the structure and the foundation and the roots correct from the beginning and start to water it the right way. And the first thing is picking the right ERP system. So, there's a lot, if you go on LinkedIn, like my LinkedIn is flooded with all these kind of new sexy ERPs. Everyone's pitching themselves as like, this is the modern day NetSuite. This is the modern day, whatever. And that's great, but you have to go with what is actually right for your business, for your vertical, for what you're trying to do, and making sure that that's going to output directly and long-term into the right way for you. And what we're seeing in a lot of deals is people are opting for some of these newer ERPs to do their accounting and operations and things like that. And ultimately it's not yielding the results that they want. And that's coming through as part of our financial and tax due diligence. And they're ultimately having to switch back to the QuickBooks and the NetSuites because they're just proven and they have the right infrastructure to do so. So that's just one element of kind of setting yourself up the right way from the beginning.
Yeah, and let's face it, Nick. Sometimes when people are starting out or whatever, there's so much going on. They're very much obviously they need to focus on generating revenue and all of that. Sometimes these operational pieces get pushed a little bit to the side, or something will come back on later. And obviously, the longer your business goes on, the lack of proper systems is going to bite you eventually, anyway.
Absolutely, yeah. And I think that's another big piece and important piece of it too. Is like, the deals that we do where I think sellers are trying in earnest to basically put together good financial systems. But what ultimately happens is in doing so, because they don't have the right team behind them or the right infrastructure in place, they actually make more work for themselves, not only like at that point in time when we're doing the diligence, but over the years as they've attempted to do things the right way. But sometimes keeping things as simple as possible, the better, up until the point where you're like, okay, I want to start thinking about going to market. And at that point, starting to bring in the right advisors to help you prepare to maximize value and to think about things in the right way. So I think that's like a piece of advice I would give to sellers and entrepreneurs that are thinking about starting a business is like, you don't have to defer your revenue if you're a SaaS business right off the bat. I mean, you can,
Right.
but like it's not always something that you need to do. Like focus on what you need to focus on in the early days, which is identifying the right markets, identifying customers, identifying like how you're going to pay the bills and cash flows and things like that. The super technical accounting is not the most important thing day one. So
yeah. And then what advice would you have for business owners who are thinking about selling a business? I mean, what are some of the first steps they should take in order to make it as smooth a process as possible?
definitely having your processes, operations, playbooks, financials in order is one step. And not to kind of shamelessly plug for a quality
Sure.
of earnings, a sell side quality of earnings, but I think there's a lot of value in that. I think it's an accretive investment for sellers and for people looking to go to market. But you have to kind of be empathetic in the way that you're thinking and think about what a buyer is going to think about. The purpose of a quality of earnings is to understand not only the pure quality of earnings, but the quality of revenue as well. And the more you prepare for that and the more you have your numbers in place, the better you can better defend against what a buyer might come back to the table with and either try to retrade against or take purchase price reductions against. So, of course, a buyer, when you think about like talking about technology or SaaS businesses and you talk about quality of revenue, they're going to look at your ARR, they're going to look at your MRR, they're going to look at your gross churn, they're going to look at your net churn, they're going to look at retention, they're going to look at your CAC, they're going to look at your LTV, and they're going to look at your customer concentration. So how you kind of think about those things going into an acquisition are really, really important, and making sure you have the story of it down pat before you start to pitch to investors is very, very important. We get asked to do sell side quality of earnings where buyers are already in place. And at that point, to me, it's too late. But you really want to prepare and be intentional about when you go to market and how you prepare your books, your records, your operations, your playbooks, and what you use to kind of sell and pitch. So,
yeah, because at the end of the day, let's face it, I mean, a buyer wants generally speaking, wants the least pain possible, right? They want something that not only can they acquire, but they can easily integrate, they can easily take over and operate, or they can integrate with their systems, etc. So all of that ground. So when you're representing buyers, that's one of the things they look at, like how well prepared is this business? Is it going to be an easy acquisition for me? Does it have a complicated ownership structure? Does it have, as you said, is the earnings, are they relatively forecastable, predictable, or do I have to apply big discounts? These are things obviously that you can offset if you're well prepared.
Exactly. That's very, very, very well said. Is a buyer, so nobody wants surprises on either side. Everybody wants a smooth process. And the more you prepare for this process on both sides and are transparent and forthright with these things, the smoother it goes. And it doesn't matter the size of the business, the complexity of the business, the industry of the business. Being prepared is really the biggest first step in having a successful transaction. And then, of course, there are other elements of finding the right partner and finding who you're actually shaking hands with and signing on the dotted line with. But yeah, I mean, just having everything in an ERP organized, not essentially like gapified. Like I'm not suggesting, these small businesses need to account for prepaids and have capitalization policies and, apply all the technical accounting, but having it in the system by vendor is really, really important. So then a buyer can go in and be like, is there concentration risk? Is there supply chain risk? Are they reliant on one vendor versus another? Like, what does this business really look like? What am I inheriting? What am I stepping into day one? And what are the opportunities to continue to grow this business post-close? Where are the operational synergies? Where are the opportunities to raise prices? Where are new verticals or new services I can offer? So, there's more to just looking at the face of the financials. That's that next layer that you're peeling back to say, what does it all look like when I actually look at the customer, the vendor, the revenue, the product level? And how does that integrate into my system? If I'm on a NetSuite, how hard is it going to be to get that in the financial system, the operation system, and really get this running and going?
Yeah. And as you mentioned earlier, also, playbooks and that. So, what is your go-to-market? How does your sales team operate? What are your sales cycles like? What's the predictability? All of those things. Because as you said, people don't want surprises, but they also want, especially, obviously on the buyer side, they want to be able to apply their models and come out with defensible results, right?
Exactly. I mean, there is a reason that a buyer is investing in this business, and there's some investors that we work with that buy and hold in perpetuity, and they just bolt it onto their platform because
Mhm.
that's their strategy. But there are other and the more kind of known playbook of private equity is you buy a business, you hold it for 5 or 7 years, you grow it, you expand the EBITDA multiple, you bolt on other businesses to it, you grow it, and then you sell it for more than you bought it for. And so when you take that secondary model and you're like, or really the primary PE model that's kind of founded this business is, what are you going to do to expand your EBITDA multiple? What are you going to do to expand your operations? How are you going to grow this thing? And so you really need to know, like, what do those, what does the operations currently look like? And how am I going to deploy my strategy day one? What is my go to market versus what it historically has been?
Mhm.
And where are the opportunities to really grow it?
Yeah. And as a bit, and on the business owner side, I mean, what are some of the things to look at so that you can make a good decision that this is the right time for me, or this is the right time for me to consider selling, or maybe I should hold off?
I think every story and every entrepreneur and every founder is going to have kind of a different inflection point
Sure.
in their life and in their story. But I think one of the main things becomes like you either want to completely hand it off to somebody and you're just, this is your baby and you're ready to retire. I think that's a big story that we see a lot is people that are just have ran this business software company for 30 years. It was an on-prem perpetual license business. They brought it to a hybrid. Now it's SaaS, and like they don't have anyone else in their family to give it to, and they're ready to sell it. Like that's kind of one. Another is like more of the buyout situation, but the seller's going to roll some of the equity. Like a lot of these people are wired very similarly. Like they want to continue doing something for
Right.
forever. Like even if they're golfing 5 days a week, they still need something to do, and they
Mhm.
still want to grow this business, but it's hit an inflection point of really stagnated growth. They're not able to expand it. They need a little bit more capital to put into it, or they want to take a dividend recap. That's another kind of inflection point. And so it really depends. Like, do you want to hand it off and be done with it for good? Or do you want to hand it over to a partner that you feel has the chops to help you grow it and bring it to the next level and be part of that story for the next 5 or 10 years as they kind of turn it over again?
Yeah, and I feel like that's those are excellent points, and I feel like those are questions that you need to obviously ask yourself, because sometimes it may sound like, yeah, I just want to hand it off to somebody else, but then again, maybe there's a part of you who wants to stay involved and wants to see. I mean, I think you have to have an honest conversation with yourself. Like, am I able to? If I'm going to let go, am I able to let go? If I'm going to stay, am I going to be as enthusiastic in 3 6 months as I am now?
You got to be realistic with it. And it also depends on the industry that you're in.
Mhm.
For my business and the business that we're in, professional services, consulting, advisory, there's key man risk. There are embedded incumbent relationships that we
Yeah.
have with our clients that are very deeply rooted. There is knowledge in our heads and experience of doing deals for X amount of years. Like it's hard to just rip and replace that. Like if you're in a service-based business services, financial services based business, you're probably going to have to stay on with that business and the new owners for some time. So
Mhm.
it's not as simple as like, I'm going to sell the business and I'm going to go be a holistic doctor and gardener in a week. Like, this is not how
Right.
it works. So,
Yeah, and if you're going to, and if that's a situation you end up in, you should also prepare for that, because if you end up as, if it is a recap, or they're a minor, or if they're a majority owner, whatever, but you're staying on, remember you're the one who's going to be held responsible for all those projections, all those financial projections. You're going to be there, so you better make sure they're as accurate as you can make them, and not be trying to pad things.
yeah, they're going to have the buyers absolutely going to have you rep to certain statements. That's the reps and warranties. That's why there's
Yeah.
RWI insurance. And that's why sellers, unfortunately, sometimes indemnify buyers for any breach of those reps and warranties. I mean, there are just certain things that you have to sign off on. So, and we see it, unfortunately. So,
Yeah, yeah, and has things changed over the last number of years, Nick, on terms of what buyers are looking for, like in terms of What particular traits are they looking for businesses? I mean, for instance, like a couple of years back when money was cheap and free, like everybody was just like investing and go growth, growth, growth. Now a lot of investors are looking at, is it a stable business? Is it profitable, or does it have a path to profitability? Is it sustainable? Some of those things have changed, right?
I think so. I think there's the way that the investors that we work with look at these businesses are multifaceted,
Mm-hmm.
multi-layered. They're looking at a number of different things, like not only like almost like without a doubt, does the business have to have a strong quality of earnings, meaning there's low customer concentration risk for the most
Mm-hmm.
part. They have a balanced product that they're going out to the marketplace and offering, so they're not kind of concentrated on one product that could kind of go under. They're not concentrated on one vendor. Like there is a good
Mm-hmm.
recurring revenue base, and it is growing. Maybe not at the clip that you'd want to see from a venture or growth business, but it's growing, and there's opportunity to continue to grow it. But also, it goes into how are they actually able to finance the deal, and how does it actually fit their strategic narrative in the long term as well. And so the financing component and the valuation component is really interesting, because you got to that same point. Financing was really cheap. Like you could get multiple terms of
Yeah.
debt in the past for a very low interest rate, which made IRR and all of that easier to achieve and getting
Mm-hmm.
over that hurdle. Now debt is less cheap, and also there are less terms of debt from what I'm seeing from the lenders I'm friends with on every deal, meaning you have to put up more equity. So
Mm-hmm.
when you're putting up more equity, you're going to be more strategic in what you're actually doing, and valuation levels have come significantly down from 2021 and 2022, where the sellers I think are still like, I want to sell it for what it was trading at 21 and 22, and that's just not what assets are trading at
Yeah.
anymore. And so for buyers, like you want to get the best deal, you don't want to overpay. And so understanding like, okay, if a SaaS business is trading at 3x recurring, is that a good deal for me, and how do I kind of flip this into a strategic initiative for my business long term? So I think there's a lot at play there, and there's just more that they're looking at. And I think the downstream implication of that is there's just more deals breaking,
Mm-hmm.
because they have to check all these boxes. The other
Yeah.
piece too is there's just significantly more competition now too. Like you have the lower middle market private equity funds and private equity funds that are backing platforms that are doing deals in this, what I call lower middle market.
Right.
But the mega funds are also like, the lines have been blurred so significantly that it's not as segmented as it normally was with the different tranches of market. You have everybody playing kind of everywhere, at least the
Right.
top down. And you have search funds, and you have independent sponsors, and you have entrepreneurs through acquisition, and you have family offices. Like there's more competition for the same number of assets. So that's kind of made it more, what's your story? How do you partner with them? I'm not just throwing a check at them. I want
Right.
to actually help this business.
Yeah, no, and I think that's a really interesting one, as you say, with the different investment sources now, so that again, it all points back to again is like having everything in order in your own house. So if you're looking to sell, you have many different options. One of the things that I just wanted to come back to, and I think this is a really good one for anybody who's listening who has started their own business, is looking for those points of failure. As you said, like concentration risk. Do you only have a couple of really big customers? Do you have a good segment? Are you focused in one geography or location or whatever? Are you are 90% of your sales like one product as opposed to others? So lots of different things to look about. As somebody who's looking to purchase a business, they're always looking obviously for these kind of points of failure.
Exactly. Yeah, I mean, it's definitely really important for sellers to get in front of, because that's something that could scare a buyer away. And from a buyer's perspective, it's an opportunity to be like, well, there is risk here, so maybe
Mhm.
that warrants a little bit of a retrade or a discount on the initial enterprise value that we ascribe to it, but we still think that there's an opportunity to grow it. And that goes back to my initial point of being transparent,
Yeah.
being able to know everything up front and being in front of it to tell the story correctly. That's the biggest part of it. Like you
Mhm.
just don't want any surprises. Like that's
Yeah.
where deals get hairy and start to break, is where things come out in the last hour and you're like, I can't swallow this. I just
Right.
can't. And then there's tons of time that's wasted, money that's wasted, and everybody leaves kind of, disappointed.
Yeah, absolutely. Well, listen, thanks very much, Nick. All of Nick's information will be below this video. But before we go, Nick, please do remind people about who you are and what you do.
Yep, I'm Nick Spezio. I'm a managing director at EXBO Group. We're a boutique consulting firm based in New York City. We do office of the CFO for venture-backed, growth equity-backed, private equity-backed businesses, and sit in that strategic role for them as they kind of stand up their finance function. And we do transaction services work, financial, tax, operational due diligence for private equity financial sponsors as they navigate the deal lifecycle.
Excellent. Well, listen, I would encourage you to go check it out. If you're on either side, buy side, sell side, go check out their services. Thanks again, Nick. Thank you for watching and listening, and I will see you all again very soon. Thank you.
Thank you, John.